And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporates and Investment Banking, proud sponsor of the African Mining Indaba 2025. Good evening. Welcome to the program tonight. And try as we might to not talk about the person in the White House. It is really just impossible. Let me try very hard. The focus tonight is on what the European Union is going to do in response to the man in the White House. They're going to, of course, have a firm and proportionate response, was the language from the EU in response to those tariffs of 25% on all steel and aluminium going into the United States. The question, of course, is how does any country in the world deal with us? And this is a big question for us. And let me just sort of let you know where I stand. I think I've made this point before. I don't think this is about rationality. I don't think this is about sitting Trump down and saying, these are the facts, let's convince you. I don't think it's about that at all. It's either about a deal, stop supporting, Gaza and stop supporting Palestine, which is not on the table, frankly, from our side, I don't think, or it's about politics in the United States, and it's got nothing to do with facts. And that's what's going to make this so difficult. The only plus side on all of this for us is the gold price, $2,940 at one point today, sliding back down below $2,900 at one point. I suppose the question is, would you buy gold at $3,000? If that's where it goes, is that where you would really find value over the medium term? The World Gold Council said, telling the Money Show last week, they expect 2025 to be a strong year for gold for the entire year. If you consider that this is driven largely by Trump, a couple of other factors, I suspect, central banks building up their stock of gold, for example. But if it is being driven by Trump largely, well, then you would expect that this is how it's going to be for quite some time. But still, gold at 3,000, would that be value over the longer term? I don't know about that. And then the other big question: are we going to see a real realignment of global trade? And we'll speak to Wandile Seklobo about this in a little while. In other words, are we going to move in a way away from the US, the complete opposite of what Trump wants? And it won't just be us. I suspect it may be other countries too, closer to China, for example, could be one of the things that happens. I think there's a lot suddenly on the cards. There's a lot that is possible that wasn't possible just a couple of months ago. By the way, Warren Ingram tonight is talking about what happens if there is a stock market bubble. And you might want to make sure you listen to that from 7:30. If you miss it, don't forget to download the podcast tomorrow morning and maybe listen to it in your car at that time. Public-private partnerships in focus again. New rules from the National Treasury. Public-private partnerships under 2 billion rand will go through a slightly easier approval process. Still questions around the increasing role of the private sector in our economy. Let me be clear, there's no other option in many cases. We need private sector money to build the infrastructure. There's a big political argument to have here, and we don't seem to be having it. It's almost privatization. Shouldn't have used that word. It's almost a greater role for the private sector by stealth. Are you comfortable with that? 011 8830 702 021 446 0567, and of course voice notes tonight on 072 7021 702.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, with President Cyril Ramaphosa still to name the team that will go to Washington to talk or to try to talk to the Trump administration, growing fears that our trading relationship with the US is about to undergo a fundamental change. Trump is imposing tariffs, as you know, threats against South Africa as well. His Secretary of State, Marco Rubio, has said he won't attend the G20. Today, the European Union described South Africa as a reliable and predictable partner. Nothing in that statement about bad things happening to certain people in South Africa. Meanwhile, you can imagine being a company in the US with strong links to South Africa, especially if you're bringing our goods into the US. Hein April is a board member of the SA Chamber of Commerce in the US. Hein, good evening to you. How worried are your members that President Donald Trump is about to make life much more difficult for them?
Good evening, Stephen, and thank you for having us on your show tonight. I think there's a general fear from business, as it were, with regards to the new path that the United States has taken in the executive order that was signed against South Africa. This makes our members quite worried about what is the future of their business going to look. We should understand and appreciate that we are doing, the USA is our second largest trading partner, and this will definitely have a knock-on effect on foreign direct investment as things currently stand. Our markets have already taken a big knock, Stephen, just after the announcement by President Trump. And our members are extremely worried about the knock-on effect that it will have as it pertains to jobs and further investment that we continue to lobby for in the United States.
There's a big conversation on how to deal with Trump. I mean, Hein, do we as South Africa stand up to him? Do we give in to him? Do we change major planks of our foreign policy? What do we do?
It is our position, Stephen, that we keep cool heads and we continue to pursue our conversation through the diplomatic channels that is available. We believe that through conversation and through engagement with the new administration in the United States, we could still be effective in resolving the situation. You must know that it is a situation where we are not standing with bucked hands to the U.S., but we do realize that as a superpower that they are, we absolutely need the investment. You would know that we struggle with jobs in South Africa, and we've got more than 600 U.S. companies that is operating in South Africa in different spheres, and we cannot afford to have this relationship just go to waste. For the 31 years that we've got post-democracy, we've had quite smooth relationship with the United States, and we believe that this relationship can continue to bear fruit for both ourselves and for the United States.
The optimist in me wants to believe that it is possible to change Trump's policy, but I don't know if it's about facts. I think it's about politics, and I don't know if it's up for change.
Look, we try to stay clear from the political side of things. However, you would know that politics is part of business, and there's just so much that we can do. We want to take the high road, and we want to have take the position of clear and concise and true information to be shared with the United States. I think that the statement that was made, we all know in South Africa that the statement is not true. There's not a single piece of land that is being grabbed. We know that there's not a case of white South African farmers, Afrikaners, suffering a worse fate than what the economic climate is. And we would want to encourage a situation that we see our businesses thrive, and where we see that the impasse that currently exists inside or outside of the political sphere does not have a negative long-term impact on South African economy. You would know that when the economy is affected, it has got a much deeper price that the man on the street will pay than the more well-off people in our country.
Hein, we in South Africa at the moment, we're focused on this because the US is such a big economy. I don't know if most Americans really care about South Africa at all. I mean, I know Trump does, I know Elon Musk does, but is South Africa really a big issue in the United States, in American politics?
South Africa is a 1% economy if you look at the broader scale of what the world economy looks like. And it is really not, we are not in a place where we would want to be part of the conversation that Elon Musk or Mr. Trump has with regards to South Africa. But we are now on the lips of the President of the United States. In America, there is absolutely interest in South Africa, especially from the multinationals that is operating in South Africa. But it is not as a big talking point as it is in South Africa right now.
Hein April, thank you, board member at the South African Chamber of Commerce in the United States of America. Well, if the US does impose tariffs on our products, and if we get kicked out of AGOA, different sectors will be hurt in different ways. Wandile Seklobo is the author, agricultural economist at the Agricultural Business Chamber. Wandile, good evening to you. How important is the US market for our farmers?
Stephen, the U.S. market is important for the farmers, but I think perspective is important here, because if you look at how much the farming sector of South Africa sends to the world, the figures we have for 2023, it's about $13.2 billion to the world. The Americas region is about 6% of that. The U.S. around about 4%. So not big in totality, but concentrated in a very few important subsectors, citrus, nuts, and the wines. So the duty-free access that we currently enjoy is something that we find it very useful in supporting those industries.
I mean, if all of this leads to a real alignment in trade around the world, are there opportunities for us in other countries? I mean, we have been exporting a lot more to China recently.
We are exporting a lot to China and elsewhere in the world, and I think we will continue to pursue that path of opening up as many export markets as we can in other areas. But I think there's also an opportunity here as South Africa to say, okay, we are now at a space where there's a review of AGOA. And of course, if we were to be outside of AGOA, I do think that we must appreciate that the general most favored nations tariffs that apply in the US are around about 3%. So it won't be as hard, but still, they will make South Africa uncompetitive compared to other exporters that will be there. But I think the idea that it will be roof will fall, it's not actually the true interpretation, not to underestimate those industries that are concentrated there. But I think for long-term predictability, South Africa must begin to think about a more of a free trade agreement of some sort with the US as we transition there. But certainly we should explore other markets while at the same time trying to mend the relations with the US.
Wandile, I have to ask you about expropriation and the Expropriation Act. There's all sorts of political arguments about it. From the point of view of the Agricultural Business Chamber, I realize you're an economist, not their legal strategist, but is this a political storm in a teacup, or is there a real reason for farmers to be concerned?
I mean, the view from us at the Agricultural Business Chamber is that we don't see a problem here. The farmers should not be concerned, and that's the point that we have been emphasizing to the members of the chamber, and that's their understanding of this. We of the view that many of the people that have made statements outside, they perhaps are misrepresenting what the Act actually stands and says. And I mean, many people you have read, Tembeka Ngugai Toby and the others, that actually outline legally on what this plays out. But I would say, in brief, we don't foresee risks here from the Chamber's side.
Wandile Seklobo, good to hear from you on this. Thank you very much indeed. Author and agricultural economist at the Agricultural Business Chamber. You're with the Money Show, 20 minutes after 6. Well, meanwhile, I suppose, perhaps almost as a direct result of Trump, the gold price still incredibly high at the moment, going past $2,940 an ounce earlier, slipping back a little later in the day. Mankobo Madenane is a strategist FX and commodities at RMB Global Markets. Mankoba, good evening to you. Gold has been on such a strong trajectory. It seems almost inevitable that it'll go through $3,000 an ounce.
Evening, Steve. Yeah, absolutely. Thank you for having me. First of all, I just need to emphasize. I mean, this is a view we've long held. We've always said that the physical side of the gold market is quite resilient. A lot of that up wave, particularly after we broke above the 2,000 mark, was really a function of the central banks in Asia, particularly in China. And China's remained a net buyer of the yellow metal since the end of last year. So this last surge up from around the 2,800 level is really a function of that. But the other factor, Steve, I've got to emphasize, maybe a little less known, is ETF investment flows, right? Particularly out of Europe. So what we've seen, I mean, net inflows from Europe, and we know what's happening in Europe. Very anemic growth there. Several crises in the major economies, across the region. So net inflows from the ETFs in Europe are really have been a major factor as well. So we are supportive of the view that we are likely to see that 3,000, but before then we would call for a slight pullback in market prices given overstretched momentum at the moment.
Sure.
Yeah.
So from what you say, it's not all about Trump.
Yeah, so there's a confluence of geo-economic factors at play. The Trump factor is really an inflationary risk factor, and honestly, in our view, we think global markets are baking in a little bit too much of an inflation risk premium. Trump, we always say we need to take a very sanguine approach here, and Trump is very clear. Compared to the election run-up, Trump is clearly adhering to a targeted approach, which likely has far less, adverse consequences with regards to inflation risks. So, be that as it may, it is causing uncertainty. There's an impasse with China at the moment. He's looking at the Eurozone. There's still a risk of retaliation from the Eurozone. So that uncertainty certainly plays to gold as a safe haven for sure. But at the moment, I think the two leading factors are ETF inflows out of Europe. They have materially, increased since January, as well as net buying out of China's major central bank. So those are the two main factors that are leading in our view.
Mankoba, I realize predictions are impossible. I'm not going to ask you to predict when or what, but at this price, is gold still a good investment over the sort of medium term? I mean, is it really a good idea to buy gold at historic highs? Is what I'm really asking.
Yeah. So how long is the medium term? That's what we need to answer, right? But from a more, let us call it cyclical view. So let us call it through this year, right? We have a global uncertainty risk premium that will remain in play. So that naturally plays to a safe haven investment inflows. We don't think the European economy will rebound anytime soon. We think that the impetus out of China from a physical flows point of view will still be net long yellow metal. So we certainly see upside risks through the year. The 3,000 mark, I think, is more likely than not. We shouldn't be surprised if it tries to move a little bit higher than that. So from a cyclical point of view through the year, we certainly buy into the view that market prices are likely to head higher. So with that said, I think for now, one key from a technical point of view, I think market prices holding above the 2,910 mark, we think support a net bullish prognosis. So we are of the view that we will hit that 3,000, potentially as high as 3,030 in due course. Yeah.
Mankoba, thank you very much indeed. Mankoba Marinane is a strategist, FX and commodities at RMB Global Markets.
The Money Show.
The markets.
Finally, time to focus on what's happening here at home. Kwena Maloko is from Equity Research Sales at Absa CIB. Kwena, good to see you. Thanks so much for coming in. A strong update from Telkom this week, and it was interesting that their share price was up strongly yesterday. There's clearly momentum because they were up again strongly today.
That's right, Stephen. Up another 2% today. And I think when you first read the headline, when the number came out, it kind of looked a little bit boring. But if you focused on the consumer business that houses Telkom Mobile, you saw some really strong numbers there. So service revenue growth growing ahead of the market, so almost 10% there. But importantly, on the milestone side, you've got now 24 million mobile subscribers, and that's a 21% jump. You're seeing that the mobile data users are up 17%. And importantly, they've stopped losing customers in the postpaid segment. And in that segment, the spend there is about 3 times higher than prepaid. So all of these are well supporting the margins in Telkom, which then supports the free cash flow, which has been a problem in the stock for some time. So this, again, sort of boosted the share price as investors now look at this positive story and try to price that in.
I mean, just generally, you get a sense that Telkom is now a strong, well-run business, and that's what people want to buy in.
Exactly, and also when you have a better balance sheet, you're able to compete with the bigger guys a lot more strategically rather than defending the whole time. So it sort of brings the entire dynamic in the telco space to a more interesting place. But before you get there, I think you try pricing what the upside could be. We'll get a full update, the full year numbers in the next quarter. So that should be where we actually get a much more robust picture of how their operations are going.
There was a warning from Impala Platinum today that their headline earnings could be down, if I understood it correctly. And yet their share price ended up quite nice. Well, not up nicely, but it didn't take a big hit.
That's right. But also, importantly to note, it was up, let's call it 1% versus the peers that were down between 1.5% and 2%. And I think, as you rightly say, you look at that headline warning and you think, things have gone wrong. But if you look at the things that the company can control, those are the things that got a little bit better. They couldn't do too much about their selling prices. So they were selling, let's call it 8% lower year on year. But if you look at production and some of the assets, they were stable. They weren't great, but stable. And importantly, they were able to maintain full year production and costs were maintained. So I think the market is just giving the benefit of the doubt here that for what the company can control, they are controlling.
You heard all the commentary about the gold price just a moment ago, $3,030 on the cards. I mean, still I have a question or two about whether it's wise to buy at this level.
Yeah, I think traditionally, right, gold followed the Federal Reserve rate path expectations. And I think what you're seeing today, I mean, we were charging along and we're kind of slipping today, is a function of what the federal chair has said. He's come back, calm the market to say that they will remain data dependent and there isn't big cause right now to sort of decrease rates. But I think the point remains, as the previous guest mentioned, is that gold at the moment remains the safe haven choice for tariffs. And as long as that continues, you'll see gold supported, especially because the market gets so volatile.
So much more to come in the story, isn't there? Kwena Maloko, thank you so much, from Equity Research Sales at Absa CIB, bringing the time on The Money Show to 6:30.
WhatsApp Stephen
On 072
702
1702.
Good to hear from you tonight. And of course, lots to talk about. Once again, a lot of it driven by the US President Donald Trump. You might well have a view on 011 883 0702 or 021 446 0567. It keeps coming back to the same thing. How do we respond? What do we actually do? I keep making the same point. I don't think that Trump's mind can necessarily be changed by sustained rational argument based on facts. I don't think it's about that. I think this is all about something else. Well, amid all of the fuss and the bother of the Trump administration, a suggestion this week from the chief economist at Standard Bank, Goolam Ballim, that global citizens are in what he calls a place of discontent. But, he says, South Africa is in a position of hope, maybe, I suppose, different from the rest of the world. Well, Goolam Ballim is on the line for you now. Goolam, good evening. We're completely immersed in the sort of minute-by-minute coverage of Trump. We forget about the bigger picture. You suggest voters in different countries are in a place of discontent. What is driving that?
Good evening, Stephen. Thanks for having me. So, perhaps to start off with, if we reflect over the last 3 years, there has been 33 elections across key markets. And in well more than half of those elections, incumbents have lost power, and often incumbents in their first term of office. So the idea of discontent is perhaps to suggest that we have what we also call the K economy. K as in the letter K, reflecting one leg, where there is increasing prosperity for elites and upper middle class individuals. However, there is declining economic welfare for low income class and low middle income classes. So in other words, this idea of a K economy is prevalent in many developed markets as well. Put differently, the rich getting richer, the poor getting poorer. And that economic circumstance then allows for populism to surface, and populist leaders also, let's call them big men, to emerge, who, with an element of charm and a degree of persuasiveness, then address people's attention and offer them hope. And so I would argue that Donald Trump is not necessarily unique or also an individual who has a particular view that has appeal. He is a sign of our times. where the prevalence of hardship and discontent, as you've rightly described it, is shaping politics, domestic politics, generating leaders like Donald Trump, which is then having a very substantial geopolitical impact as South Africa, Canada, Mexico, and China, and the rest of the world is experiencing.
Okay, you would think then if countries voted for change and they got that change, they'll be more optimistic about the future, but I don't know if they are.
And I think that's right, in a sense that the easy solutions will probably remain elusive. So Donald Trump seems to be upending the global order that we've been familiar with for the last 7 decades, 70 years. He is introducing policies that, in fact, may come back to bite Americans. It will upset citizens in due course at many levels. I could just argue, for instance, the tariffs, if they are sustained, will cause inflation to rise in a few months. And in a few quarters, growth in the United States will be tempered by these tariff increases, again, if they are sustained. So the additional thing that I would just mention that the U.S. should be mindful of is if we look at 8 of the fastest growing trade corridors around the world exclude the U.S. And in fact, many of them have China as a terminus. So when you raise tariffs, if in effect it's like Brexit, you are exiting the world trading system. And as with Brexit, almost a decade later, the United Kingdom has come to realize that its economy is smaller than it otherwise would have been had it remained integrated in the global system. So there's some perils as a result of Donald Trump's choices that will come to pass in due course.
And I mean, currently, the current British Prime Minister, I think, was due to go to a sort of meeting of European sort of heads of state last week, and sort of skulk around a little bit and make sure he was vaguely photographed but not seen too prominently. I mean, this is the kind of problem this leads to. There's still some hope around, and some of that's actually here in South Africa, largely because of the sort of national coalition we have in government. That hope won't last forever, and I would suggest that hope will last at least until December 2027, the ANC Leadership Conference, and after that, all bets are off. I don't know if we're seeing enough real change in the time that we kind of know this window of change is open for.
Stephen, I concur with you. I think it's an accurate arc. But I first want to celebrate the idea that the possibility that the government of national unity could endure for, roughly speaking, another 3 years is material for the prospect of reforms galvanizing and continuing to engender a stronger economy. So put simply, the government of national unity certainly is suppressing ideological biases amongst individual parties. Parties are, even if clumsily at times, coalescing around the reform agenda. There is good self-interest, for example, for Cyril Ramaphosa and John Steenhuisen to stay in the government of national unity than to be out of it. And survey data indicates that citizens are actually supportive and believe that the government of national unity is working quite well. At least 60% of citizens think it's working quite well. So all in, I would say up until 2027, if we can get progress in the reform agenda, and if we can get trend growth up to 3%, in a sense, there's a bidirectional where the GNU creates better prospects for growth, and better prospects for growth locks in a more stable political climate, and the parties that contribute to change, stay cohesive. But I agree with you. The next ANC leadership is going to inherit whatever reforms we have that generate growth, and is going to determine whether those policies continue. It's right to be anxious because the history of our political cycle and recent elections has been whenever the ANC leaders change, there is substantial policy redirection. So you're right about 2027. My sense is that the leadership contestation is still open, and I don't think we're going to get clarity on that through 2025 at least.
No, I mean, I would have to agree with that. Within all of this, we're a medium-sized economy, sort of, in a very choppy sea at the moment. And the person who's running the biggest economy has made it clear he is opposed to us. He's bluntly opposed to what South Africa stands for. Could Trump fundamentally damage all of the progress the National Coalition is trying to achieve?
No, I don't believe President Trump, despite the heft of the United States and the political influence that he has, can derail our underlying direction of travel. I'm not going to suggest that the United States is unimportant, but a few things. I would say that the U.S. takes in 9% of South Africa's exports, and that's significant, but it also pales in comparison to China at around 30%, the rest of Africa at around 28%, and Europe at around 23%. So there are alternative partners that could be considered more allies in our international and commercial relationships than the United States. With respect to AGOA, which is one instrument of endeavor, and we concede here, if AGOA is cancelled, yes, it is a headwind. It will compromise, in our view, South Africa's GDP growth by 1/10 of a percentage point. Now, that may not sound large, and certainly we wouldn't welcome losing any tenths of a percentage point, but that's entirely plausible and probable. My sense is with the United States, with the muscle diplomacy that is emerging out of Donald Trump, we must brace ourselves for the worst. And I think, as you suggested at the beginning, approach it with the idea that we seem to be, by negotiating with the United States, we're approaching a gunfight armed with a knife. We're coming with a boardroom approach and mechanics to a street fight. And we're not likely to win, one, because our tactics are inappropriate, and two, America can dispense with South Africa in an instant. And in that respect, as I say, we must brace ourselves for the worst, strengthen our allyship with the countries that are friendly, and use the G20 as a pivotal moment, not only for South Africa's prominence in the global economy, but I suspect that this G20 on African soil, on South African soil, is probably the most important G20 in years to come and in recent years, because it effectively can serve as a platform when the world will decide to what extent they're going to cling to multipolarity, to democracy, to allyship. And the global south now is no more just emerging markets, but it could be other developed markets like Europe that is being assailed by Europe. So G20 this year matters, and coincidentally South Africa is hosting it. And it's an opportunity for us to at least tether together the rest of the world while the U.S. steps back.
Goolam Ballim, thank you very much indeed. Really appreciate it. Chief Economist at Standard Bank.
You're listening to The Money Show with Stephen Grootes, brought to you by Absa Corporate and Investment Banking, proud sponsor of the African Mining Indaba 2025.
6 minutes now to 7 the time. Well, confirmation today, the National Treasury now trying to make it easier for government departments, government entities to enter into public-private partnerships. They're creating a separate approvals process for projects that cost less than 2 billion rand. Obviously, there seems to be a bigger role for the private sector and government projects in the economy at the moment. I don't need to remind you of the need for government to improve and update our infrastructure. Professor Jan Havenga is a professor of logistics at the University of Stellenbosch, also director at the Gain Group. Jan, good evening to you and thank you for your time. Will this change make much of a difference? I mean, clearly the National Treasury is trying to find ways to make it easier for these lower price projects to get going.
Thank you for the invite. Yes, I think all of this fits the same playbook that Treasury has been doing, and I would call it fiscal responsibility of improving South Africa's debt situation, of getting our federal debt grading fixed. A lot of these things put together, and it fits different playbooks from different places as well. The Minister of Transport is driving a PSP office with real vigor. I noticed she's not only opened up an office, she's stocked it with really good people. The same cabinet meeting with the roadmap for freight logistics trains has been improved. We also saw from the Department of Transport a PSP framework from the Department of Transport be improved. So all of these things add together, and it's good news, and it fits what we are trying to do with economic reform in South Africa at the moment. It fits also the fact, which I'm very happy about, and that's the government of national unity have differences about education and about health and stuff like that. They don't have differences about economic reform. It's very much the same. I work in the transport space, and I think one of the helpful things that I'd like to see now is to make it easier to do business with Transnet as far as this is concerned, because Transnet is also driving a PSP agenda. And it's not that they don't want, they really want, but Transnet as a conglomerate put together the way that it is at the moment, with basically, as far as we all are concerned, overvalued assets, a debt burden that's completely unbearable, it really should be unbundled. And it will make it easier to actually, with the smaller projects, to deal with the smaller portions of Transnet. That makes much more sense. I think there's a dream that Transnet in its current form can maybe trade itself out of difficulty. I don't think that's possible. I think that disaggregation and unbundling of Transnet will make everything like this easier. But this is a step in the right direction. That's great.
Sure. Okay, very interesting. I mean, I presume National Treasury is still involved. It's not just go and do what you want as a government entity. I mean, National Treasury is still overseeing, properly understanding what agreements are being signed. This is the private sector. They do have a motive. I don't need to remind you.
I read it carefully, and I think Treasury has actually done it very cleverly here. They said they're going to streamline the process, they can make it easier to happen, but if you read carefully, they keep their oversight in place. So I'm not concerned that Treasury will not have the oversight in place. I could carefully and clearly see that they did not let go of that. So that is good.
Is there that big an appetite on the side of the private sector for these projects? I mean, in some cases, it's obvious. You know, some people in the rail sector, for example, are desperate to have their privately owned trains running on sort of railways that are currently owned by Transnet. I understand also that government needs the help, but I don't know if there's something in it for the private sector in every sector or with every government entity.
There's been a huge appetite to get involved in many things. For as long as I've been involved with Transnet, even before Transnet was formed, when we created Transnet in the late 80s and in the early 90s, there's many projects and things that people want to do that I'm aware of, where the actual biggest stumbling factor was red tape, was the fact that government wasn't ready for this, that the government wasn't prepared for this, all of the things that happened with us. So there's a huge amount of appetite, but you do touch on a very important point. And that also comes back to the disaggregation and the unbundling of Transnet. There's various roles within Transnet. Some of it is public good roles. They look like Sunrail. You know, if you look at the rail infrastructure track, if you look at the port authorities, those are not things that makes money per se as a business. This is where infrastructure is created so that the rest of our economy can flourish. And they should be treated differently. I mean, Sunrail gets government grants. So it doesn't make sense if you have a road-to-rail strategy. On one side, you've got a railway that has to look after itself, and the other side is a road that government funds. So the things that government should take responsibility for and fund should be seen separate, and there the way in which the private sector makes money is different. Like if you think about the road sector, there it's concessioning, the infrastructure concessioning, etc. But it's and it's not as a business as such. Sunrail is not a business, and that distinction needs to be made, and this process will work better. And it includes taking things like Port Authority and the rail infrastructure manager as far away from the current Transnet as you can, and as far away from the Transnet's balance sheet as you can.
Professor, really appreciate the time. Thank you. Professor Jan Havenga is a professor of logistics at Stellenbosch University, director of the Gain Group as well. In a moment, Nedbank, they've got a new offering, they say, for mid-corporates or for mid-level corporates. Despite all of the advertising that banks do, I don't know if corporates really change their banks very often. We'll find out more about that. Victor Gomaswana will tell you what's happening in our continent today. And don't forget, Warren Ingram talking about how to know if a stock market bubble is about to go bang. It's 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, proud sponsor of the African Mining Indaba 2025. Good evening. Welcome to the second hour of the program. There's so many different things going on in a sort of hour-by-hour basis that all are really based by what someone in another country is doing. It's easy to forget what's actually happening here. And we'll speak to Nedbank in just a moment. They've got a new product out, they say, for mid-level corporates. I'm always interested in this. Banks spend, as you know, quite a large amount of money on advertising. How much of it works? Now, look, let's be clear. They wouldn't do it if it didn't work, okay? I mean, that's just obvious. It's rational. But getting a corporate, getting a company, if you're running a mid-level corporate, I mean, how often have you, as an individual, changed your bank? I mean, have you ever? I mean, I haven't, and neither has my father, and it's the same bank. And he started, I think, because his father was with a bank. I mean, another sort of 15 years or so, that's 100 years of banking, you do get to that point sometimes. So if you're a company and you've got to change a bank, isn't it a mission to do? Have you ever done it? Maybe you've been involved. Maybe you supply a company that's done it and has actually been a pain in the neck, or maybe it was the easiest thing ever. Be good to hear from you on that on 011 883 0702 and 0214460567. Voice notes tonight as well on 072 702 1702. Warren Ingram, who, as you know, is a person to sort of really trust when you're considering where to put your money, he's talking tonight in Personal Finance about how to spot a bubble. Now, there's no sort of easy way. And there's been a lot of discussion in the US about whether the tech stocks there in particular, and especially after the arrival of DeepSeek, the Chinese AI model, was sort of getting kind of bubble-like proportions. And when you consider just the sheer value of an NVIDIA shares at one point, that did sort of make sense that something might one day happen, or it raised fears. But those fears were based only on the valuation. They weren't based on anything else. And so quite difficult to work it out, but you might want to focus on that and listen to that from 7:30. If you miss it, maybe go back, get the podcast tomorrow morning, send it on to whoever you think needs to hear something like that. Good to hear from you tonight on The Money Show.
702. Stephen is on The Money Show.
6 to 8 p.m.
All right, that big launch today by Nedbank of what they call their mid-corporate value proposition. They seem to be promising a bespoke model for mid-level corporates. Herman de Kock is the executive for mid-corporate coverage at Nedbank Commercial Banking. Herman, good evening to you. I'm sure it's been a busy day, so thanks for the time. What are you offering here to corporates?
Good evening, Stephen, and good evening to the listeners. Yes, been quite a busy and exciting day. And, just to put it very briefly, what we're offering to the mid-corporate client base is a bespoke coverage model. And within that bespoke coverage model, it includes not only bankers and servicing, but it also brings a dedicated credit model with a bespoke credit policy, credit committee, only focusing on mid-corporate entities. And maybe just quickly to define for the listeners, what do we mean by mid-corporate? And this is really the significant entities, usually R1 billion in turnover, well-established, strong growth track records, but they kind of fitting in between the conventional business banking and corporate investment banking. And what we've picked up in the research that we've done and engaging with these clients in the market was that they really need this unique model that brings solutions that fit their needs.
Do you believe what you're offering here is new in the market? I mean, is it really that new a service?
I think it's really important that we need to understand the mid-corporate client has always been in the market and play a key critical role in the economy. So mid-corporate clients as itself are not new. But what we bring are banking solutions that we now retrofitted to really speak to the relevance of the mid-corporate market. And in that sense, we believe and we are convinced that what we bring to the market is new. And it's also inspired by the clients because we engage with clients that fit the mid-corporate profile. Those that bank with Nedbank and those that don't bank with Nedbank yet. And the intent and what we learned from them was there's really this need to bring the banking solutions, sophisticated solutions, but make sure that it is designed for the needs of the mid-corporate client. So in that sense, we are confident that it is new and something fresh that we bring to the market, rather than to try and solution for mid-corporate clients through a business banking or a corporate investment banking paradigm.
I mean, for this to work, you need to be doing something that either other banks aren't or you need to be doing it better than them.
Absolutely. I think what is really important is the way that we bring our sophisticated solutions to this client grouping. We are really focused on bringing bespoke solutions that are customized for the mid-corporate clients, and that range from entire suite of sophisticated banking solutions, but very importantly, also with that, a strong advisory service. And especially within the mid-corporate market, where there's often a focus or strong growth thesis, that component of bringing advisory is key critical. And we do that, for instance, through a very well experienced and deeply knowledgeable leverage finance team that bring together with the structuring of the balance sheet, the corporate finance, corporate advisory, tax advisory, and even private equity in some cases. Because what's very important for the mid-corporate client base is that, yes, we need to bring progressive funding, and it also needs to take on a flavor of investment banking.
Do corporates really change banks that often? I mean, I realize there's a lot of advertising around and all the rest, but I mean, do you find that corporates are actually happy to switch banks? I mean, you need to give them something that they're not getting already. There has to be, whether it's an easier life for the people who are running it, whether it's more money in some way, a slicker or more efficient service or something. But do you find that companies really are happy to, especially in this sort of mid-corporate range, are happy to change their banks?
I think in this case, if we just see how the market is responding and the interest that we are receiving from positioning the mid-corporate value proposition in the market, our existing clients that fit mid-corporate really welcome this solution that we bring to them, and also the referrals that we receive from our loyal clients, which we really appreciate. One thing is important. It's not always easy to switch banks, especially if you are a well-established business with an established balance sheet. But what we bring to mid-corporate is not only the sophistication of solutions, but also a high-touch service model. In other words, we make the changing of banks, or even just taking the first step of trying out Nedbank mid-corporate, seamless and easy and frictionless for our clients.
So you're entering this mid-corporate market. You're doing something, you say, that is new. I mean, you obviously want these mid-corporate companies to keep growing, and they'll stay with you while they do that. And you'll want to be encouraging people who are just a little bit smaller than that level to start moving into that level. I mean, obviously you want your customers to grow over time and move from one level to another, to put it another way.
That's very important, Stephen. I think if we just take a step back and look at the overall Nedbank commercial banking value proposition that we bring to the market, and this ranges from obviously entities with much lower turnovers than what I position, our bigger picture approach that we bring to the market is focused on enabling and unlocking growth for clients. And as mid-corporate, with a very strong collaborative culture that we have between mid-corporate, corporate investment banking, and the rest of business banking, we keep a very close eye on clients that are starting to show the signs of a mid-corporate entity and growing into that space, so that there's a seamless transition then into the mid-corporate value proposition. And I have to add also, within mid-corporate, we are very close to our clients to actually pick up when there are the necessary or relevant triggers that now shows that they are going to grow into a corporate investment banking client. For instance, if there's an IPO on the horizon.
Thank you very much indeed, Herman de Kock. Really appreciate the time. Executive for Mid-Corporate Coverage at Nedbank Commercial Banking. Do you think that's a proposition that's going to sway you? 011 883 0702 021 446 0567.
702. Stephen is on X.
At Stephen Grootes.
Good to hear from you this evening. Well, time to find out a little bit more about what's happening on our continent when it comes to money. Victor Khomaswana is the author of Africa Bounces Back, also Marketing Communication Executive Director at the University of Limpopo, in for Rotendo this evening. Victor, it's been a long time, my friend. Nice to talk to you again. Good evening.
Evolve all in the new year.
Stop it.
well, Trump has made it that old. I see.
It's been a long 3 weeks. Okay.
It's been a long 3 weeks. Yeah, it's going to be longer, 4 years. Oh, man.
Yeah. 3 years and 49 weeks, I think. We got to be careful.
You're traumatized. You're counting that seriously?
Okay, right. Our continent, not his. Nigeria, looking at Nigeria, and we all remember the Abacha loot. Sani Abacha, of course, dictator, and money that was stolen. The US may halt the repatriation of it. I mean, this is money that should really, by right, belong to Nigeria.
Yeah, and that's Trump for you. So let's give the background. Sani Abacha and a lot of other dictators, it's not just Sani Abacha. Lots of dictators in Africa stole money from the coffers of the public, stashed it in Swiss bank accounts, and some of them stashed it in the States, some in Europe. And since 2010, America, the U.S. has had this initiative called the Kleptocracy Asset Recovery Initiative. And they have repatriated several millions of dollars to countries like Nigeria, DRC, Ethiopia, I think, and Kenya. The same with other Swiss bank accounts. Now comes Donald Trump 2.0, and he says, no, stop all that. So he tells Pam Bondi, the Attorney General, to stop all that or consider stopping all that so that he can redirect the money to fighting crime like human trafficking and narcotics. Now, here is where the problem is. When you look at the story of African money that's lying in foreign Western bank accounts, and you look at the collaboration that it took to get that money back, you will understand why this is a dangerous move. Remember, Stephen, the Western banks didn't care much about giving money back to Africa. It didn't care much about know your customer until 2011. Not 2011. What is it? September
9/11, yeah.
Yeah, 9/11, that's what I'm looking for. Because that proved that by being nonchalant or indifferent towards the movement of illicit money from country to country, you are inadvertently supporting terrorism and all those. And that's where Basel II came in and a whole lot of other, which are good things, by the way. So I'm very worried that President Trump, by just doing this rash move, he's going to do a lot of damage to the repatriation of the money. Even the former minister, Alison Madueke, she's not been long out of office. She's been hiding a lot of assets in the States. There is another case that you might have spoken about on air, which is was in the UK court, and there was money being traced to a former minister of oil, petroleum resources. So it's such a frustrating thing, because if you've been looking to repatriate the money, Donald Trump might have just put a stop to that. And I don't think this man understands that America became the superpower it is by working with other nations, not against them.
It's also, I mean, why do it? You know, I mean, there's a story in the Financial Times today, I think it was, suggesting he's going to halt the enforcement of a law that basically makes it illegal to bribe a government official in another country by an American company. I mean, according to legend anyway, it was an American company that demanded that law because they were tired of having to bid against them and other American companies.
Yeah, Sarbanes-Oxley Act and a whole lot of anti-corruption bid, and now Donald Trump is coming. But you know what? That's just Donald Trump being Trump.
Yeah, well, yes. Our biggest refinery, South Africa's biggest refinery, could hit its full capacity in a month at 650,000 barrels a day.
That caught me by surprise, Stephen. I've been watching this barrel, 650,000 barrels per day. This is the refinery, the largest in Africa, and in the world, the single train, as they call it, is one of the largest. It's Dangote, of course, who built it over a period more than 10 years. Spent $20 billion or more to build it, and he has done a lot of good for Nigeria, because what he has done, he has created a surplus, a country that has been importing refined petroleum products. Africa's largest producer of oil, many times exporting crude oil and importing petroleum products. He has stopped at that. And the interesting thing is, for the past 18 months, he has been battling the bureaucracy in Abuja. He has been stonewalled. He has been complaining that the suppliers of crude oil have not been forthcoming. He even accused the authorities in Abuja of sabotaging his project. But he has been the entrepreneur that he has always been known to be, and he has prevailed. But what I did not expect was that with all the problems that he was facing as recently as 6 months ago with the supply of crude, he would have been already close to achieving 100% capacity. But let me tell you this, 100% capacity will not even begin to dent the supply, the demand that is there in Nigeria. And the interesting thing is, he is advancing so fast, Stephen, because he is exporting already to other countries. He's not necessarily selling to Nigeria, which means he can double the capacity, but he's not going to have to do it by himself. There are 2 or 3 other refinery projects by people like Abdullah Saad Rahman, who are building refineries and are following the lead of Aliko Dangote. We talk about groundbreaking significant developments. Even for the richest man, this refinery is something to talk about in that sense.
It's fascinating just to watch it play out, isn't it? And then Mozambique getting financial aid guarantees from international institutions. And we remember the big scandal and Manuel Chang and his time here for a while. All of that really dented their credibility.
Yeah, and they did. You know, there was a sad story I read 2 or 3 days ago that you remember there were about $2 billion that was in that tuna bond scandal. The ship that were the tuna whatever machines that they were getting out of that. I think they are going to get just about $6 million for that, Stephen. It's $2 billion, and all you can get is 2.6 or so million dollars. That's not good for the economy. But here's the thing. So Mozambique is like most African countries, an over-indebted customer. But you do what? You get all your creditors and you get them together. And that's what they did. The African Development Bank, the United Nations, they got the International Finance Corporation, that is in the World Bank Group, and they got the World Bank itself. And they brought them together in a meeting with the Minister of Finance, Maria Lucas, and they said, we would like to make sure we reassure the world that Mozambique will continue to enjoy our support. What that does, Stephen, is like you get a stay of execution. Instead of somebody running away, because that's what started the crisis in Mozambique in the first place, when the IMF ran and said we are no longer supporting this. They are now back and they are saying we will continue to support Mozambique. It looks like a charitable gesture, but it is not. The reason is that the World Bank has already billions of dollars invested in Mozambique. So it wouldn't do them any good to scuttle the composure of other creditors. So that's why they are doing this. So it's diplomacy at its best, but I'm glad that at least this important economy of Southern Africa will not be made to be running helter-skelter looking for all kinds of, because then they would end up having to borrow money to pay off the debt that will be maturing. That's been the case with countries like Kenya.
And I mean, Mozambique, we need a stable, growing Mozambique on our border. We don't need political trouble. We don't need an insurgency.
I mean, you saw they're already blocking the border. That's an economic crisis. They blocking the trucks at the border because they are complaining about the cost of living. We don't need that after that Mondlane versus Chapo standoff. We need that economy stable. You know why, Stephen? It is Southern Africa, but it's also Eastern Africa, because whatever happens in Mozambique affects East Africa because of that border Mozambique shares with Tanzania.
Thank you very much indeed, Victor. Nice to talk to you, my friend. Victor Khomaswana, author of Africa Bounces Back, Marketing and Communications Executive Director at the University of Limpopo, as well in for Rutendo Ndwingwi this evening. In a moment, we'll hear from Warren Ingram about when do you know that the markets are about to hit a bubble, when things are about, do I even need to say it, to burst, bringing the time to 7:30.
The Money Show.
Personal Finance with Warren Ingram.
And Warren Ingram, the co-founder of Galileo Capital and a certified financial planner, talking tonight about whether the stock market is in a bubble. And you can imagine what happens if a bubble bursts. Suddenly, as an investor, you lose a large amount of money. Warren, I imagine this is a question that people ask all the time in all sorts of sectors in particular, and for various reasons, perhaps quite a lot more recently.
You're absolutely right, Stephen. I think if you look at what's gone on in the last while in the US, where we've seen those very big tech shares just jumping up again and again and again in price, it becomes concerning for a lot of people because logic dictates that something can't carry on going up forever, and we would be tempted to think, well, what on earth do a few tech shares have to do with a South African investor? But unfortunately, the US is by far the biggest stock market in the world, and when you look at its value as a percentage of the world stock market, it's somewhere around 2/3 to 70%. So if the US stock market has a big correction, a big burst, then it unfortunately will have a big impact everywhere. So it is a concern for a lot of people right now, and quite a few people I'm hesitant to say old enough, but old enough to remember what happened in 2008, and certainly the last very big bubble that related to technology was the IT bubble that burst in the year 2000. So it is top of mind for a lot of people and a real valid question. Are we sitting in a situation where we've got a bubble that's about to burst on us?
How do you identify it? And I realize that's an impossible question because, some people I think will immediately look at, well, how quickly has this value arrived and could it go equally quickly? But are there any sort of ways of pre-identifying a bubble?
I'm going to sit on the fence a little, but give some good pointers. So one, whatever we look at, you're right. It's impossible to make a absolutely iron cast prediction to say we're certainly in a bubble and it's about to burst, or everything's fine, don't worry, and then I know what will happen is it'll burst tomorrow. So what we need to know about bubbles is that they become a psychological phenomenon. So it's not a calculation where you can say, well, if the 10 biggest shares are trading on valuations of 50 PEs, and I'll maybe explain that now, but if that's the case, then you're in a bubble. It would be lovely if there was a very simple mathematical calculation, but it's not. And why PEs are important is it tells us about the actual value of a company. So instead of talking about the share price, where we would say, well, 10 years ago, the share price was $1 per share, and today it's $1,000 per share. It's a phenomenally expensive share. That's not really a measure of a value of a business. What you have to look at is what's the PE ratio. And the PE ratio says how many years of current profits do you have to justify to pay the price today. In other words, if the PE is 50, that means it's 50 years worth of profits to pay for the share price today. And that's a phenomenally expensive company. So PE is very important. And you would think, well, we could just look at the PE ratios and everything will be fine. But that's not true, because if companies do very well, if their profits tend to grow, then the PE ratio might actually come down even while the share price is going up. So we've got to look at this and say it's not mathematical, it is psychological. And there are, I think, three factors that we can look at. And the first one is a wonderful phrase coined quite a few years ago by the chairman of the Fed in the past, Ben Bernanke, and he spoke about irrational exuberance. And essentially what that means is the economy is pumping, the bulk of and we're talking about America now particularly, but the economy is pumping, the bulk of people who want a job have a job, their salaries are rising, they feel very comfortable and confident that things are going to continue getting better, and they can't see any reason for things to go wrong. So I don't think we're in that state right now. I mean, yes, the American economy is at full employment, and salaries have started to rise, but a lot of Americans are very unhappy because they've got a cost of living problem where cost of living is going up much faster than their salaries, and people are not just generally happy. I mean, there's a reason why so many of them voted for Donald Trump. It wasn't because they were all thrilled with what was going on under Biden. So I don't think we're in a state of irrational exuberance.
I mean, I suppose,
and then
I'm sorry to interrupt, but I mean, I'm reminded of what happened before the Great Depression, where people did think things were going to get better, and when it burst, it was a big shock. I mean, it's a completely different sort of state of mind now, where people are actually generally pretty unhappy.
Generally very unhappy, even if their lives are actually not bad. It doesn't feel to them that life is good. It feels to them that they're worse off than their parents, and certainly worse off than their grandparents. And I think in America, it's probably true to say that someone who's 25 years old now might actually live a lifestyle that's worse than their parents, but it's probably way better than their grandparents. The size of houses in America is better, standard of living is better, but maybe this is the point where standard of living has started to turn. Having said that, there's so much going on in the world. There's global conflict. Globalization is probably reversing to some extent. Countries are becoming more inward-looking, more hostile to their neighbors. We're not in a good space. So I agree with you. I don't think everyone's all happy and kind of living in the roaring 20s of the 1920s sort of style of life.
One of the other things, and you sort of point to this around psychology, is a kind of belief in the next big thing. Now, the Dutch, famously, it was tulips. It's something very different now.
It's definitely not tulips, that's for sure. So I think we saw a little bit of this kind of mania when OpenAI launched ChatGPT 3, and we saw a lot of hype. People kind of downloading this phenomenal app that was going to change everything and make everything easy tomorrow. And so that built a little bit of momentum for a short period of time. And I think people started to become convinced that AI was going to be a transformative technology. But having said that, I think that sort of, major excitement might have gone out a little bit. I think people have started to play with, these AI chatbots a lot more, and they're realizing that in some instances, they can make a difference. They can make life a bit easier. In some instances, they're making life a lot harder, and actually it takes more time to interrogate the chatbot than it does to just do the job. And so I think the skepticism is there, and I think business leaders are certainly looking at it, and they're spending some money on technology. But equally, there are lots of people out there saying, you know what, this is an important technology. It's going to lead to changes in the way business gets done in some respects, but some of the life-changing, business-changing kind of hype that was there in the beginning is probably overdone. So I don't think the whole world is stuck on this next big thing is going to change everything next year hype that we might have seen in the past. I don't think we're ticking that box with this kind of belief at the moment, Stephen.
Your questions for Warren Ingram, personal finance this evening, 011 883 0702 021 446 0567. There's another issue you point to, which is FOMO, fear of missing out.
I think we have such a great example of this. When Bitcoin really started accelerating in share price properly and went onto the radar of everybody, and I always talk about my hairdresser, and my hairdresser, when he starts telling me to make investment decisions, I know he's my indicator. He's the canary in the coal mine, because I know him very well, and he's not an investment guru, but what he does do is he listens to his clients all day long, and when he starts telling me about an investment theme, I start to pay attention, because it means that there might be this FOMO hype that's built in. And that's what happened with crypto. People had no idea what Bitcoin was. They had no idea of the underlying drivers of what was making Bitcoin interesting to some people and potentially a transformative technology. But what they did know was their mates were talking about it. There were the handful of stories about how much money you could have made. And so people started piling into something simply because everybody else was doing it and they didn't want to miss out. And that's a critical condition for a bubble. When people are just piling into the stock market or the currency market or whatever the market is of the moment with no logic. And I think that tulips is probably a great example of that. People were buying tulips for no reason than because everyone else was buying and they didn't want to miss out. And I'm not convinced we're in the FOMO state of mind right now. I think we were there with crypto. I think that bubble did burst. Yes, it's come back somewhat since then. But I don't think people are buying into the stock market at any price and without regard for potential risks. So I'm saying we're not ticking the FOMO box either, Stephen.
I suppose the other thing about a bubble, and this is a strange thing, is that if people kept buying, the bubble wouldn't burst. So it's much more psychological than value-driven, because it's really based about the future perception of value.
You're right. And we're in a space where when we get into a bubble, people stop thinking about 2, 3, 5 years' time. They start thinking about how much money they can make in a week or a month. And they start to do silly things like they borrow money on their credit card. They sell, I've seen stories of people selling their homes to get the money out of the equity in their house so that they can become day traders. And you start to see really crazy behavior because people believe there is only one direction that this market can go, and it's up, and it's going to go up very quickly. And that sort of psychological phenomenon, you see it in the madness of crowds. And to be, when you look at a typical mob, the mobs are not intelligent. They're not the aggregate of everybody's intelligence in the mob. In fact, they're worse. The average intelligence of a mob is below the lowest intelligence of anybody in the mob. And I think that's what happens when you look at markets, is you see people just stop thinking altogether and just start acting on kind of a large mass mentality, a herd mentality. And we're talking about bubbles now, and so that's when prices are rising. We see that equally when when people reach a state of fear and the panic spreads. And then people stop thinking in reverse, and they just sell everything because they believe there is nothing in the world that will ever go up again, which is obviously not true. So I think we're when we're in a bubble, we're in a state of greed, and it's immense greed, and it becomes this force of nature, and it's very hard to stand in its way. I think often you have to get out of the way, but you don't want to participate in it. And that's what I'm struggling with right now, is we're looking at a market that has done very well. The US stock market's done very well for a period of time. Share prices have been rising. Valuations of the tech shares are high. And so that's not a good sign, because, when you buy a company that's expensive, it's not likely to double in value over the next 5 years. It's probably more likely to either remain flat or to go down. But that doesn't describe every share in the US or every share in the world. So what we're in now is a situation where some shares have done incredibly well, and others, particularly if you're an index investor in the UK, you must be really bleak now. And if you're buying a lot of European shares, they haven't done well. So there are lots of places where you can find value, but maybe not in the big 10 tech shares in the US. And I think that's a distinction people need to make when they're looking at this bubble conversation, which is what people are asking at the moment.
We're talking to Warren Ingram this evening, certified financial planner. We're talking, of course, around how to spot a bubble. 011 883 0702 021 446 0567. Your personal finance questions for Warren. Also, a question from Sipiwe asking you tonight, Warren, is Donald Trump's focus on South Africa a big concern? He doesn't understand what is happening here. I'm worried about his next actions against our country. Sipiwe, we'll have an answer for you in just a moment.
You're listening to The Money Show with Stephen Grootes, brought to you by Absa Corporate and Investment Banking, proud sponsor of the African Mining Indaba 2025.
The Money Show.
Personal finance with Warren Ingram.
Your questions, your calls for Warren Ingram. A question, of course, from Sipiwe tonight, Warren, saying President Donald Trump's focus, is it a big concern that he's focusing on South Africa? He doesn't understand what's happening here, and I'm worried about his next actions against our country. And in a way, Sipiwe, I think you've summed up the Money Show for the last couple of days. Warren, I'm worried. Should we be?
I think we need to pay attention. I think one of the things about that I'm learning about Donald Trump is you need to take him seriously, but maybe not literally. And I think, that's maybe the great learning from his first term as president. I'll never forget the phrase, I'm going to build the wall and I'm going to make Mexico pay for it. And what people needed to realize there was the intent behind what he was saying and not the practicalities. And I think that's important, understanding that he is a transactional person. And so he looks at South Africa. There is something that he wants from us. Or something that he wants us to stop doing, and if we can make it seem that we've given him his way, then his focus will move elsewhere. And already, I think, a country like Jordan is starting to feel that, Jordan and Egypt. So number one, Sipiwe, it's very unlikely that he's still talking about South Africa in a year's time. But number two, our government needs to be very smart about understanding what he wants, and then making sure that we either are prepared to give it to him or that we find a way to get off his radar, because you cannot fight the American government. You can't fight the size of American money, and you don't want to set yourself up in opposition. No, even if he doesn't go as far as, sanctions and all of those things, which I see some people are writing about, and I think we're far from that. But if he just stops trade deals, etc., that can get us, into severe difficulty. So I think strategically there are things we need to do, and one of them is we can't be belligerent. We're not big enough to be belligerent, and to feel like we're morally right. That's great when you're sitting on enormous amounts of money, but when you're not, you've got to be careful. And so I'm hoping that he moves on and that we do something to kind of make him feel like he's got a victory, and then we carry on. What's very interesting to me is if I look at the rand, I look at our stock market. it's not, we're not sitting at 22 Rand to the dollar, and our stock market hasn't lost 30% of its value. And that tells us something. It tells us that the bond traders, the stock traders, and the currency traders are looking at this as some kind of an issue. Yes, things have moved a little bit, but they're not in deep panic and selling South Africa out completely. And so I think we should not be complacent. We require our politicians to do something unusual, which is to act quickly, act sensibly, act rationally, and to try and diffuse the Americans as fast as they can. And we've got a very long history over the last decade or two of voting against America almost every single time on principle in places like the UN, and we need to stop doing that. But we can get through this if Trump moves on and we do something right that he wants. And I'm not saying right as a moral thing, but just play the game correctly. That he's playing a game, we have to play his game. We can't play our own. But I'm not panicking yet. I am concerned. I am watching, and I ideally hope that he kind of behaves like he's done in the past, which is he moves on to something else, once he's got some kind of a victory. And I feel that's what we need to do, is give him a victory. What I really like, Sipiwe, is we've got one of South Africa's best political minds asking the question. We should be asking you, Stephen, what do you think?
I'm afraid to say I am not convinced Trump is going to go away, because I think we are everything he stands against. And that is what concerns me. So we will have to see. Also, Elon Musk, of course, in his ear. But I suspect where I think it's going to get very interesting is I think he might move on from Elon Musk at some point. And that's really where things are going to get very, very interesting. But Warren, it's a reminder of how one election can change the world for investors very, very quickly. And the election in the US last year was such an election. It was such a big political event that's going to have ramifications for shares in different places for a long time to come.
It will, and it will create volatility. But I think one thing we need to know about stock markets is investors tend to get used to things fairly quickly. So once they understand what the new normal will be, then they adapt to that, and they then invest accordingly. So I think understanding what Trump's mandate is over this next 6 to 12 months will set the tone for the rest of his term. And at the same time, there's a lot going on in South Africa that's very positive. If we see a sensible resolution to the NHI funding, for example, I think that was a huge risk that might be, kind of negotiated off the table. If we keep doing the things that are sensible as a country, then I think we get ourselves through this, maybe come out the other side in a much better position. So I'm not panicking about Trump yet. I might be naive, but I think he's going to focus on a lot of other issues as well.
Warren Ingram, thank you very much indeed. Always good to talk to you, and of course, interesting to hear your thoughts about what is happening around that and the whole idea of a bubble which could at one point pop. Warren Ingram is co-founder of Galileo Capital and, of course, a certified financial planner.
You're listening to The Money Show with Stephen Grootes, brought to you by Absa Corporate and Investment Banking, proud sponsor of the African Mining Indaba 2025.
Plenty to come. Aubrey Masango is, of course, up next, and there will be a lot more coverage to come from the EWN, the Eyewitness News team, as well, of events through the evening and into tomorrow. We will be looking once again to the White House, but also I think we're about to enter the phase, I'm looking at the production team, of what is going to be in the budget next week is probably going to be the next theme. 2 nods, not just one, 2 nods to that. And I think that is probably what is going to start to move our agenda forward in the next little while as well. Good to be with you as always. Back again tomorrow. Good evening.